Hello and welcome to today's video, where we'll discuss how to invest in the stock market during times of inflation and recession. Investing in stocks can be a powerful wealth-building tool, even during challenging economic periods. In this detailed guide, we will be covering all the essential steps and strategies to help you navigate the stock market with confidence. We have divided this guide into 5 informative parts, each focusing on a crucial aspect of investing. Whether you're a beginner or looking to enhance your investing skills, this guide has got you covered. If you're interested in a specific part of the video, feel free to check the timestamps provided in the description box below. Let's get right into it. Before diving into investing, let's first understand the basics of the stock market. Stocks represent ownership shares in publicly traded companies. When you invest in stocks, you become a shareholder, entitling you to a portion of the company's profits and potential appreciation. However, the stock market can be volatile, especially during times of inflation and recession. Therefore, it's crucial to develop a solid understanding of the market dynamics and investment strategies. Inflation refers to the general increase in prices of goods and services over time, resulting in a decrease in purchasing power. During inflation, the value of money decreases, meaning that you need more money to buy the same amount of goods or services you purchased in the previous months or the year before. This is influenced by various factors such as government policies, supply and demand dynamics, and the overall health of the economy. This can impact the stock market in several ways. Inflation can have both positive and negative effects on the stock market. On the positive side, some companies can benefit from inflationary pressures, especially those operating in sectors such as energy, commodities, and real estate, which tend to see increased prices during inflationary periods. Additionally, companies with strong pricing power and the ability to pass on increased costs to consumers may also fare well. On the negative side, inflation can create uncertainty and volatility in the stock market. It erodes the purchasing power of future cash flows, which can affect the valuation of stocks. Higher inflation may lead to increased interest rates, which can make borrowing more expensive for businesses and dampen consumer spending. This can have a negative impact on corporate earnings and investor sentiment. Understanding how inflation affects different sectors can help you make more informed investment decisions during these periods. A recession is characterized by a significant decline in economic activity, often measured by a contraction in gross domestic product, GDP, over 2 consecutive quarters, employment, and business profits. During a recession, stock markets typically experience a decline as investor confidence wanes, corporate profits decline, and unemployment rises. However, not all stocks are equally affected or perform poorly during a recession. Certain defensive stocks, such as those in sectors like healthcare, consumer staples, and utilities, tend to be more resilient as people continue to require essential goods and services. Conversely, cyclical stocks, such as those in sectors like consumer discretionary, industrials, and financials, are often more sensitive to economic fluctuations and may experience greater declines during a recession. During periods of inflation and recession, it's important to adopt a long-term investing mindset. Investing in stocks is inherently a long-term strategy, and trying to time the market based on short-term fluctuations can be challenging and risky. While short-term market fluctuations can be unsettling, history has shown that the stock market tends to recover and generate positive returns over the long run. By adopting a long-term perspective, you can avoid making hasty decisions based on short-term market volatility. This allows you to stay focused on your investment goals and take advantage of compounding returns, which can significantly enhance your wealth over time. By staying invested in quality companies with strong fundamentals and competitive advantages, you increase your chances of weathering economic storms and achieving long-term financial goals. Investing in the stock market involves a trade-off between risk and reward. It's important to understand that higher potential returns are typically accompanied by higher levels of risk. Stocks offer the potential for higher returns compared to other asset classes like bonds or cash, but they also come with higher volatility and the risk of losing money. During times of inflation and recession, market volatility can increase, leading to more pronounced price swings. As a beginner investor, it's crucial to assess your risk tolerance, which refers to your ability and willingness to tolerate fluctuations in the value of your investments. Are you comfortable with short-term fluctuations in your portfolio's value? Can you remain invested during periods of market downturns without panicking and selling at the wrong time? Understanding your risk tolerance will help you determine an appropriate asset allocation, which is the distribution of your investment portfolio across different types of assets, such as stocks, bonds, and cash. Diversifying your investments can help mitigate risk by spreading it across different asset classes and sectors. Now that you have a grasp of the stock market, let's establish a solid foundation for your investing journey. This section will cover essential steps to prepare yourself before diving into stock investing. Before you start investing, it's crucial to define your financial goals. What do you want to achieve with your investments? Are you saving for retirement, buying a house, or funding your children's education? Setting clear and specific goals will help you determine your investment horizon, risk tolerance, and the strategies you'll employ to achieve those goals. Each goal may have a different time frame and requires a different investment approach. Longer-term goals can typically tolerate more risk, allowing for a higher allocation to stocks, while short-term goals may require a more conservative approach with a higher allocation to low-risk assets like bonds or cash. Take some time to evaluate your short-term and long-term financial objectives, as this will lay the groundwork for your investing journey. Write down your goals and the time frames associated with each one to guide your investment decisions. Before investing in the stock market, it's important to establish an emergency fund and manage your debt. An emergency fund acts as a financial safety net, providing you with funds to cover unexpected expenses or income disruptions. Aim to save 3 to 6 months' worth of living expenses in a liquid and easily accessible account, such as a high-yield savings account. Additionally, it's wise to manage your debt effectively. High-interest debt, such as credit card debt, can be a significant burden on your finances. Pay off high-interest debt, such as credit card balances or personal loans, before considering stock market investments. This will ensure that you're in a strong financial position and can focus on growing your wealth without the burden of excessive debt. However, not all debt is created equal. Low-interest debt, like a mortgage, may be manageable while investing. Consider your debt situation and make informed decisions on how to allocate your resources effectively. Understanding your risk tolerance is crucial for successful investing. Your risk tolerance reflects your ability to withstand fluctuations in the value of your investments without panicking or making impulsive decisions. It's important to assess your risk tolerance honestly and realistically, as it is influenced by factors such as your age, financial situation, investment knowledge, and psychological attitude toward risk. An honest assessment of your risk tolerance will help determine an appropriate asset allocation that aligns with your comfort level. If you have a higher risk tolerance and a longer investment horizon, you may be comfortable with a higher allocation to stocks. However, if you have a lower risk tolerance or a shorter time frame for your goals, you may prefer a more conservative approach with a higher allocation to bonds or cash. Remember, risk tolerance is personal, and it's essential to invest within your comfort zone to avoid making emotional investment decisions during market downturns. Compound interest is a powerful concept that can significantly impact your investment returns over time. It refers to the ability of your investment gains to generate further gains when reinvested. It allows your investment returns to generate additional returns over time. The longer your investment horizon, the more time your money has to compound. By starting early and staying invested, you can harness the power of compounding and potentially achieve significant growth in your investment portfolio. If you would like to learn more about compounding, I have linked a video down in the description box on how compounding works. To become a successful investor, it's essential to continuously educate yourself about investing principles, strategies, and market dynamics. There are numerous resources available to help you learn about investing and develop your financial knowledge. Books written by renowned investors, such as The Intelligent Investor by Benjamin Graham, or Random Walk Down Wall Street by Burton Malkiel, and my current favorite The Simple Path to Wealth by J.L. Collins, provide valuable insights, timeless investing wisdom, and how we handle our finances. Blogs and websites dedicated to personal finance and investing, like Millennial Money and Get Rich Slowly, which are my current favorites, offer articles and tutorials on various investment topics and up-to-date information and analysis. Online courses and webinars can provide structured learning experiences, covering everything from basic investing principles to advanced strategies. Many financial institutions and reputable educational platforms offer these courses either for free or at a reasonable cost. Take advantage of these resources to enhance your investing knowledge and make informed decisions. Remember to do your research and due diligence when it comes to paying for courses from any sources, be it here on YouTube or someone else's website. One thing that we have now in this digital age is the availability of free information on the internet. Do take advantage of these resources to expand your knowledge and enhance your investing skills, but it is safer to consult a financial advisor for any important information you need to know before getting into the world of the stock market. A well-defined investment strategy is key to successful investing. In this section, I'll walk you through the process of creating your own investment strategy to navigate the stock market during inflation and recession. One of the most crucial elements of an investment strategy is asset allocation, which many may know as diversification. Asset allocation refers to the distribution of your investment portfolio across different asset classes, such as stocks, bonds, and cash. Diversifying your portfolio across different asset classes can help reduce risk by spreading your investments across various types of assets and increasing the potential for consistent returns. During inflation and recession, it's important to review and potentially adjust your asset allocation. Stocks have historically offered a hedge against inflation, as companies can potentially pass on increased costs to consumers. Bonds and cash may also play a role in your portfolio to provide stability and liquidity during uncertain times. Consider your risk tolerance, time horizon, and financial goals when determining your asset allocation. A younger investor with a higher risk tolerance and a longer time horizon may allocate a higher percentage of their portfolio to stocks, while an older investor approaching retirement may choose a more conservative allocation with a higher percentage in bonds and cash. However, it's important to maintain a balanced approach and not overly concentrate your investments in one area. A well-diversified portfolio can help protect against market volatility and maximize potential returns. When it comes to investing in stocks and selecting stocks for your portfolio, you'll encounter different investment styles, with two prominent approaches being value investing and growth investing. Value investing involves identifying stocks that are considered undervalued by the market. Investors following this approach look for stocks trading below their intrinsic value, often indicated by metrics such as price-to-earnings ratio, price-to-book ratio, and dividend yield. So what's the difference between these metrics? The price-to-earnings ratio is a financial metric that compares a company's stock price to its earnings per share. It indicates how much investors are willing to pay for each dollar of the company's earnings and is commonly used to assess the relative valuation of a stock and compare it with other companies or the market as a whole. The price-to-book ratio compares a company's stock price to its book value per share. It represents the net value of a company's assets after deducting its liabilities. It is used to evaluate whether a stock is trading at a premium or discount relative to its accounting value. Dividend yield represents the annual dividend payment as a percentage of the stock price. It's a measure of the return generated from dividends relative to the stock price. It is primarily used by income-oriented investors seeking regular income from their investments. Value stocks tend to be more resilient during market downturns as they are perceived to offer a margin of safety. On the other hand, growth investing focuses on identifying companies with higher growth potential, even if they may be trading at higher valuations. Growth investors seek companies with high earnings growth rates, innovative products or services, and expanding market share. Growth stocks can provide significant returns during periods of economic expansion but may be more volatile during market downturns. Balancing value and growth stocks within your portfolio can provide diversification and exposure to different market segments. Consider your risk tolerance and investment objectives when deciding on the allocation between value and growth stocks. Dividend investing involves selecting stocks that pay regular dividends to shareholders. Dividends are a portion of a company's profits distributed to shareholders as a cash payout or additional shares. Dividend-paying stocks can provide a steady stream of income and potentially offer a cushion during market downturns even if stock prices decline. When selecting dividend stocks, consider the company's track record of dividend payments, dividend yield, and the sustainability of the dividend payments based on the company's financial health and cash flow. However, keep in mind that dividend stocks may not always outperform non-dividend paying stocks, so it's important to evaluate them based on your investment strategy and goals. When it comes to investing, there are various strategies you can consider during times of inflation and recession. Let's explore 4 commonly known strategies that can help you navigate the stock market effectively. 1. Dollar cost averaging. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the stock market's price fluctuations. This approach can be beneficial during periods of market volatility and uncertainty, such as during inflation and recession. By consistently investing a fixed amount over time, you buy more shares when prices are low and fewer shares when prices are high. This strategy helps reduce the impact of short-term market fluctuations and takes advantage of the potential for lower prices during market downturns. Dollar cost averaging also eliminates the need to time the market, as you invest regularly regardless of whether the market is up or down. It promotes discipline and a long-term investment mindset, helping you stay invested even during turbulent market conditions. 2. Buy and hold strategy. The buy and hold strategy is a long-term investment approach where you purchase stocks and hold them for an extended period, regardless of short-term market fluctuations. This strategy is based on the belief that, over the long run, the stock market tends to generate positive returns. During periods of inflation and recession, market volatility may increase, leading to short-term price fluctuations. However, by staying invested and maintaining a long-term perspective, buy and hold investors aim to capture the overall growth of the market and benefit from compounding returns. This strategy requires patience, discipline, and a focus on fundamental analysis to select high-quality stocks. 3. Dividend reinvestment. Dividend reinvestment is a strategy where you automatically reinvest the dividends earned from your investments back into buying additional shares of the same stock or other stocks. Instead of receiving the dividends as cash, you use them to acquire more shares, thereby increasing your ownership in the company. This strategy allows you to harness the power of compounding, as the reinvested dividends generate additional dividends in the future. 4. Options trading. Options trading is a more advanced investment strategy that involves using options contracts to speculate on or hedge against the price movement of stocks. Options trading gives you the right, but not the obligation, to buy or sell a stock at a predetermined price within a specified time frame. During periods of increased market volatility, options trading can provide opportunities to generate income or protect your portfolio against potential downside risks. However, options trading requires a deep understanding of the options market, including risks and potential rewards. It's important to thoroughly educate yourself and consider seeking guidance from experienced options traders or financial advisors before implementing this strategy. Market timing refers to the attempt to buy or sell stocks based on predicting the direction of the overall market. Attempting to time the market, or predicting when to buy or sell stocks based on short-term market movements consistently and accurately, is challenging even for experienced investors. Market timing requires accurately predicting market tops and bottoms, which is notoriously difficult. Instead of trying to time the market, focus on your long-term investment goals and stick to your investment strategy. Consistently invest over time, regardless of short-term market fluctuations. This disciplined approach helps you avoid making emotional decisions based on market noise and improves your chances of capturing long-term market returns. Rather than trying to predict short-term market movements, focus on the quality of your investments, diversification, and staying disciplined. Remember, investing is about time in the market, not timing the market. By staying invested and avoiding the temptation to make drastic changes based on short-term market movements, you increase your likelihood of achieving your financial goals. When selecting stocks, it's important to conduct research and analysis to make informed investment decisions. Two common approaches to stock analysis are fundamental analysis and technical analysis. This analysis includes evaluating financial statements, such as income statements, balance sheets, and cash flow statements. This approach focuses on the company's underlying value and potential for long-term growth. Technical analysis, on the other hand, focuses on analyzing stock price patterns, trading volume trends, and market indicators to identify potential short-term trading opportunities. Technical analysts believe that historical price and volume data can provide insights into future stock price movements. Chart patterns and trend lines are commonly used in technical analysis to identify potential buying or selling opportunities. Both fundamental and technical analysis have their merits, and some investors use a combination of both. However, it's important to conduct thorough research and analysis and not solely rely on one approach. Developing your analytical skills and staying updated with company news, economic trends, and market developments will improve your ability to make informed investment decisions. While it's essential to focus on the long term when investing, having an exit strategy is equally important. An exit strategy outlines the conditions under which you would sell a stock or exit the market altogether. During inflation and recession, market conditions may change rapidly, and having a clear plan for when to exit an investment can help protect your portfolio and capture profits. Your exit strategy can be based on factors such as reaching your financial goals, changes in the company's fundamentals, the need for liquidity, or significant changes in the market or economic environment. Regularly review your investments and assess whether they align with your investment strategy and objectives. Be prepared to make adjustments or sell stocks if they no longer meet your criteria or if market conditions change significantly. To invest in stocks, you'll need to choose a reliable stockbroker and set up an investment account. This section will guide you through the process, ensuring you have the necessary tools to start investing. When choosing a stockbroker, you'll encounter two primary types: full-service brokers and discount brokers. Full-service brokers provide a comprehensive range of services, including investment advice, research reports, portfolio management, and personalized support. These brokers often charge higher fees or commissions for their services. Full-service brokers are suitable for investors who prefer a hands-on approach, seek professional guidance, or have complex investment needs. On the other hand, discount brokers offer self-directed investment platforms that allow you to execute trades independently. They typically have lower fees and commissions, making them a popular choice for cost-conscious investors. Discount brokers provide the necessary tools and resources for you to research, select, and trade stocks on your own. As they may provide basic research tools and educational resources, they generally do not offer personalized advice. Consider your investment knowledge, desired level of support, and budget when choosing between a full-service or discount broker. If you're a beginner and prefer a lower-cost option, a discount broker may be a better fit as it allows you to execute trades at lower costs while still providing the necessary tools and platforms for investing. As you gain experience and require additional guidance, you can always consider transitioning to a full-service broker. With the rise of online investing, online brokers have become increasingly popular due to their convenience, accessibility, and competitive pricing. It's important to research and compare different online brokers to find one that suits your needs. Numerous online brokerage firms offer user-friendly platforms and a wide range of investment options. When selecting an online broker, consider the following factors. Fees and commissions. Compare the fees charged by different brokers for account maintenance, trades, and other services. Look for brokers that offer competitive pricing and fee structures that align with your investment strategy. Trading platform. Evaluate the usability and functionality of the broker's trading platform. A user-friendly interface and ease of use, real-time market data, research tools, and order execution speed are essential features to consider. Some commonly known online brokerage platforms include Fidelity Investments, TD Ameritrade, Robinhood, Interactive Brokers IBKR Lite, just to name a few. Investment options. Ensure that the broker offers a broad selection of investment options, including stocks, exchange-traded funds, ETFs, mutual funds, and other securities that align with your investment goals. Customer support. Look for brokers that provide reliable customer support through multiple channels, such as phone, email, or live chat. Prompt and helpful customer service can be invaluable, especially during critical trading moments or when you have questions or issues. Research and education resources. Consider the quality and availability of research reports, educational resources, and investment tools offered by the broker. Access to market analysis, company profiles, and educational materials can enhance your investment knowledge and decision-making. Account minimums. Some brokers require a minimum deposit or account balance to open an investment account. Ensure that the minimum requirements fit within your budget and investment capabilities. Research and compare multiple online brokers to find the one that best aligns with your investment needs and preferences. Read customer reviews, explore broker websites, and utilize comparison tools to make an informed decision. Once you've chosen a stockbroker, you'll need to open an investment account. The type of account you open will depend on your investment goals and circumstances. Two common types of accounts are individual accounts and retirement accounts. An individual account, also known as a brokerage account, allows you to invest in stocks, bonds, mutual funds, and other securities. It offers flexibility and accessibility to your investments. Individual accounts have no contribution limits or restrictions on when you can withdraw funds, making them suitable for short-term and long-term investment goals. On the other hand, retirement accounts, such as individual retirement accounts, IRAs, and employer-sponsored 401k accounts, offer tax advantages and are specifically designed for retirement savings. These accounts have contribution limits and may have early withdrawal penalties if funds are taken out before retirement age. Retirement accounts provide tax benefits such as tax-deferred growth or tax-free withdrawals, depending on the account type. Consider your investment objectives, time horizon, and tax planning when deciding between an individual account and a retirement account. It's essential to understand the rules and contribution limits associated with each type of account and choose the one that aligns with your investment objectives. If you're investing primarily for retirement, utilizing retirement accounts can provide significant tax advantages and help you accumulate wealth for your future. Once your investment account is open, you'll need to fund it to start investing in stocks. Most brokers offer various methods to deposit funds into your account, such as electronic transfers from your bank account, wire transfers, or linking it to your existing bank account. Some brokers may also accept debit or credit card deposits, although these methods may incur additional fees. When funding your account, it's important to consider the minimum deposit requirements of your broker. Some brokers may have minimum deposit thresholds to open an account or access certain features. Some brokers may require an initial deposit to activate the account, while others may have no minimum deposit requirement. Ensure you have sufficient funds to meet these requirements and allocate funds accordingly. As you proceed with funding your account, it's important to note that investing in stocks involves risk, and there is no guarantee of returns. Only invest funds that you can afford to lose and ensure you have a well-diversified portfolio to minimize risk. Now comes the exciting part, selecting stocks and constructing your portfolio. In this section, I'll share some tips to help you make informed decisions and build a well-diversified portfolio. When it comes to selecting stocks, it's important to identify investment opportunities that align with your investment strategy and goals. There are several approaches you can take. 1. Top-down approach. Start with analyzing the broader market trends, economic conditions, and industry sectors. Identify sectors that you believe will perform well based on your research and understanding of the market. Then, narrow down your focus to individual stocks within those sectors. 2. Bottom-up approach. Begin by researching and analyzing individual companies. Look for companies with strong fundamentals, competitive advantages, and solid growth prospects. Evaluate their financial health, market position, management team, and potential risks. This approach focuses on the intrinsic value of individual stocks rather than market trends. 3. Combination approach. Consider combining both the top-down and bottom-up approaches. Start with analyzing the macroeconomic and market trends to identify sectors with growth potential. Then, conduct in-depth research on individual companies within those sectors to make investment decisions. Stock screening tools can be valuable in narrowing down investment opportunities based on specific criteria. These tools allow you to filter stocks based on metrics such as market capitalization, industry sector, revenue growth, dividend yield, or valuation ratios. Screening tools can help you identify stocks that meet your specific investment criteria, saving time and effort in the research process. However, remember to conduct a thorough fundamental and technical analysis of the screened stocks before making investment decisions. Similarly, various financial ratios can provide insights into a company's financial health and performance. Some commonly used ratios include the current ratio, also called liquidity, return on equity, and earnings per share. Diversification is a critical element of portfolio construction. It involves spreading your investments across different asset classes, sectors, and geographic regions to reduce risk. Diversification helps mitigate the impact of individual stock or sector volatility on your overall portfolio. Consider diversifying your portfolio across different sectors, such as technology, healthcare, consumer goods, and finance. Additionally, allocate your investments across large cap, mid cap, and small cap stocks to achieve a balance between stability and growth potential. Investing in other asset classes, such as bonds, real estate, or commodities, can further enhance diversification. Asset classes may perform differently during different economic conditions, providing additional protection to your overall portfolio. Once you have constructed your portfolio, it's important to regularly monitor and rebalance it. Market conditions, economic factors, and company-specific events can affect the performance of your investments. Rebalancing involves periodically reviewing your portfolio's asset allocation and making adjustments to bring it back to your desired target allocation. For example, if a particular stock or sector has performed exceptionally well and now constitutes a higher percentage of your portfolio, you may need to sell some of it and reallocate the funds to underrepresented areas. Regular monitoring and rebalancing help ensure that your portfolio remains aligned with your investment goals, risk tolerance, and market conditions. If you have reached this far, thank you for taking the time to learn. Investing is a journey that requires continuous learning and adaptation. Investing during inflation and recession can present unique opportunities for those who approach it with a long-term perspective. Embrace the potential for growth, harness the power of compounding, and maintain a diversified portfolio that aligns with your risk tolerance and financial goals. Thank you for watching, and I hope you found the information valuable. If you did, please show your support by liking and subscribing to the channel. Don't forget to hit the notification bell to stay updated with future videos on investing, personal finance, and wealth building strategies. I appreciate your support and look forward to providing you with valuable content to help you achieve financial success.